We'll get started, and good afternoon, everyone. I'm State Senator Cameron Bartolotta, representing the 46th Senatorial District right here. I'll do a little Vanna. There we are at the corner. There we go. Which is pretty much the heart and soul of Marcellus Shale and coal and other things energy. And I'm pleased to kick off this year's very first Gas and Oil Caucus meeting alongside my caucus co-chair, Senator Lisa Boscola. We are also joined by the caucus co-chairs in the House, Representatives Ed Neilson and Ed Neilson. Our goal for the caucus is to be an educational resource for members to discuss the responsible and safe development of our natural resources. Today's discussion will be a very timely one, given the Energy Information Administration's warning that the United States retail energy prices started this winter at a multi-year high. It is projected that households could see heating bills jump as much as 54% compared to last winter. This is not just an issue of affordability.
I know it's not even announced yet. I get that.
Hey, Zach, how you doing? This is not just an issue in terms of affordability, as we know. As we saw in Texas last winter, access to energy can mean life or death. Additionally, this price surge is not limited to the United States. In fact, it is much worse in Europe and in Asia. Consumers need a balanced grid that is cheap, reliable, and clean, both here in the United States and in regions around the world. I look forward to hearing from our industry experts today as we learn more about retail energy prices and their impact on consumers and the economy, and I'll add on national security. I'd now like to introduce my co-chair, Senator Lisa Boscola. Senator Boscola?
Oh, hi, everybody. Good afternoon. Welcome to the members of the bicameral bipartisan Oil and Gas Caucus. I'm just looking forward to today's discussion. There's so much to talk about, and I really want to listen to the experts. So I'm going to move on and just say hi.
And for our chairs in the House, would you like to kick it off?
Yes, thank you very much, Senator. We're pleased too to have a great topic that lies ahead of us, an extremely important topic. As the bipartisan Gas and Oil Caucus chairs, our goal is to work together to ensure Pennsylvania has clean, reliable, and abundant energy for everyone. So looking forward to getting the feedback, from our experts today on the panel. And hopefully this will help set the stage as we're moving forward for 2022. And also welcome Senator Boscola as the new Democratic chair to the caucus.
Thank you, Representative Neilson. Representative Neilson, if you've got a couple of words, and then we'll kick it off.
Just a couple words, not too much. Glad we can all get together. Sorry we're on Zoom and we're not all in person, of course, but this is the way of our world right now. Yeah, I just want to make one statement because I was reading the paper this week, and I want to salute another senator, Lachlan, who's on this phone. Dan came out real strong and hard, which many of us in the House and Senate do, on the governor of New York's proposed ban on natural gas hookups. And I want to go on the record to make sure everybody on this call, in this meeting, knows that there's not any support that I'm aware of for any kind of sorts, because PA is open for business, and we look forward to hearing from all the panelists. And thank you all for coming. And now my camera's off. How about that? That's why you can't see me. There you go. Now it's just not me giving a speech on the House floor. I apologize. Don't you laugh, please. I see you.
You look just like the guy behind you.
All right. Thank you, Senator.
Of course. Thank you, Representative. And again, that only took 6 minutes. Hey, we're on a roll. I would very much like to introduce not just a wonderful lobbyist and expert in the field, but a good friend, Stephanie Wisman, and she's going to launch us into this very first Gas and Oil Caucus. So good afternoon, Stephanie.
Thank you so much, Senator Bartolotta and Senator Boscola. Representative Neilson and Neilson, it's a pleasure to be here before you today and for the opportunity to talk about a very timely topic. As a reminder to the newer members of the caucus, API Pennsylvania is a division of the American Petroleum Institute. API is the only trade association that represents all segments of America's natural gas and oil industry, which supports more than 11 million US jobs. Our nearly 600 members produce, process, and distribute the majority of the nation's energy. API was formed 103 years ago in 1919 as a standard-setting organization and has developed more than 700 oil and gas industry standards to enhance operational and environmental safety, efficiency, and sustainability. So it's my pleasure to introduce to you, first up today is Dustin Meyer. Dustin Meyer is our Vice President of Natural Gas Markets. He leads API's efforts on issues related to natural gas markets, as well as natural gas technology and innovation, including hydrogen, renewable natural gas, differentiated responsible natural gas, and carbon capture, utilization, and storage. This includes working with a diverse set of domestic and international stakeholders to communicate the many benefits natural gas offers, not just to the US, but also importing countries around the world, and the role natural gas can play in a lower carbon energy future. Prior to joining API, Dustin worked for several years as an energy analyst and consultant, including at IHS Energy and Energy Ventures Analysis. Dustin has a master's in energy policy and economics from Yale University and a BA from Princeton University. Next up, we have Dr. Dean Foreman, who is API's chief economist and an expert in the economics and markets for oil, natural gas, and power, with more than 2 decades of industry experience, including with ExxonMobil, Talisman Energy, Sasol, and Saudi Aramco in forecasting and market analysis, corporate strategic planning, and finance risk management. He holds a PhD degree in economics from the University of Florida and is known for knowledge of energy markets and applying advanced analytics to assess risks in these markets. But don't let his affinity of the University of Florida fool you. Dean does have Pennsylvania roots. He hails from Pittsburgh and lived in the Lancaster area for a while. So with that, I'm going to turn it over to Dustin to lead us off.
Thank you, Stephanie, and thank you everybody on the Oil and Gas Caucus for joining us today. It is a real honor to be with you. I must apologize, as of course it always happens. My wireless internet collapsed right as this meeting started, so I'm doing this on my phone. Katrina, I believe you have the slides. Are you showing those slides? All right.
We are pulling them up right now.
Excellent.
All right, ready to go.
Okay, thank you. So again, I'm the Vice President of Natural Gas Markets here at API. The P still stands for Petroleum. A lot of folks don't recognize that we have as much of a focus on natural gas as we do, but that really is the bread and butter of my team and what we focus on. We spend a lot of time evaluating markets, not just in the US, around the world. I've spent most of my career doing this. And I can honestly say that this year is, well, actually this past year has been the most unique, the most unprecedented year in natural gas, both in the US and around the world. And this chart gives you a very easy explanation why. It's about prices. Many of you probably know that in contrast to, say, a full commodity like crude oil, there is no unified single price for natural gas around the world. There's really, when we think about it, there's kind of 3 main prices. We think of the Asian price, which is denoted by JKM. We think of the European price, which is TTF. And we think about the US price, which of course is Henry Hub. You can see them all laid out on the chart here. And especially for the European markets and the Asian markets, the escalation in prices that we've seen over the last several months is absolutely unprecedented. These are record prices all around the world. They've been averaging somewhere around $35 per MMBTU. That's, of course, is how natural gas is priced. That's the equivalent of about $200 per barrel oil. Even more recently, right before Christmas, in Europe, natural gas prices went up to $60 per MMBTU. That's $342 barrel oil equivalent. These astronomical prices are completely unprecedented. Now, the US, as you can see, is quite comparatively cheap. That's one of the many, many benefits of the US shale revolution, is that we are not exposed to these global prices like we otherwise would have been. But even in the United States, we have seen some rising prices here domestically, and that's going to impact consumers. But the context is always important. If you compare it to what's happening to these global markets, you can see how insulated the United States is. I would also be remiss not to note that this is in sharp contrast to where we were last year, or I should say in 2020. In 2020, prices did exactly the opposite. They were at record lows. We all remember, of course, famously when crude oil went to negative prices. Fewer people probably tracked what happened to natural gas prices, but there, all around the world, you had gas prices less than $2 per MMBTU. And of course, that caused a lot of commentators and stakeholders to suggest, oh, this is a reminder of the limited future for natural gas. We're overbuilding on natural gas. We don't need that much natural gas. And of course, throughout all of that, we at API said, no. This is an aberration. This is not a trend. The world needs a lot of natural gas. And sure enough, just a year later, we're in exactly the opposite scenario. And we can see what demand for natural gas is and the impact that's having on prices. We're in month 5 of this. Everybody knows that as you in the Northern Hemisphere, as you go into winter, that's where peak demand for natural gas hits. And that's a big reason why you're seeing this big run up in prices. But we're in month 5 of this. And what's ahead for the rest of the winter? You know, all signs, if you look at these global markets, is that it's going to be it's going to be continuously tight, really quite precarious. I mean, especially you look at the European markets. If they trend colder than average throughout the rest of winter, they're in genuine danger of risking physical shortages. This is not a position that you want to be in. And we're going to talk about why they found themselves in that position. In the US, the story is a little different. Just over the last month or so, you know, we've seen US markets starting to rebalance a little bit from the natural gas side. Prices, you know, at their highest, I think we're hovering north, just slightly north of $5 per MMBTU. Now we're down in that 380 range, still higher than last year, but really not that different for a winter price compared to several years past. So that's something very important to keep in mind. But just a brief overview of what exactly is driving this in the global markets. And Katrina, if you could go to the next slide. So in my mind, this all starts in Asia, and especially in China. I used to be in the business of predicting what Chinese natural gas demand would be on any given year. And it was always impossible to overestimate it, right? The amount of demand growth that we're seeing in China is really hard to wrap your mind around. You can see this chart here shows, it's a little dated and only goes through September, but this shows the unbelievable increase in demand just this year alone. It's up about 20% over last year. And we're used to comparing things to last year to 2020. Sorry, that's 2 years ago. I have to keep reminding myself that it's 2022 already now. But compared to 2020, oh, well, maybe gas demand, you know, collapsed in China in 2020 during the depths of the pandemic. That actually isn't the case. Gas demand in China was quite strong in 2020. What you're seeing in 2021 is that it's that much stronger still. When they're buying meeting this additional demand, really their only choice is to bring it in through LNG, liquefied natural gas. It's hard to ramp up more capacity via pipeline, right? So when that demand is increasing, they're out there on the LNG market buying every LNG cargo that they can. China is now the world's largest LNG importer. They overtook Japan just this year for the first time. For the entire history of the LNG market, Japan has always been the world's largest LNG importer until this year. It was overtaken by China. That, along with continued robust demand from the traditional buyers of Japan and Korea, has really locked in this Asia Pacific market as being very, very tight and buying every LNG cargo that they can get their hands on. And of course, as we know, if you're talking about Chinese energy purchases, these are usually done by state-owned companies. They're not terribly price sensitive, especially going into the Olympics, starting here in a couple of weeks. They really cannot afford even the possibility of having some sort of blackout. And so that is why they have been so aggressive out in the LNG market, bringing in those cargoes. That makes life very difficult for the other major importing market, which is Europe. And Katrina, if you go to the next slide here, So let's look at what's happening in Europe. Europe used to be a fairly sizable producer of natural gas, but that's not the case anymore. And what we've had this year specifically is they had a cold winter and then a hot summer that increased natural gas demand year on year. That made it difficult for them to move gas into storage. And so this first chart on the left here shows just how short Europe is storage at this time of year. It's way below the 5-year average. There were some concerns similarly in the US market back in October, November, that we were running a little below our 5-year averages for storage, but that pales in comparison to the delta that Europe is experiencing right now. This is a really, really scary situation for them. So they can't pull gas out of storage. Domestic production is falling throughout Europe. So their only choice to meet this demand is to lean on more imports. Well, where do they get their imports from? On the pipeline side, as we know, by far the largest supplier of natural gas to Europe is Russia. And here, the chart on the right, you can see how dramatic the decline is in pipeline flows from Russia to the EU just in the last couple of years. They were quite high in 2019, they were lower in 2020, and now they've really plummeted in 2021. I'm not going to open up the Pandora's box as to why this dynamic persists. It is very clear that the Russians probably could be sending more gas to Europe right now, but they are not. And so that leaves Europe with only one other supply option, and that's increasing their LNG import flows. But as we just saw on the last slide, in order to do that, they have to outcompete the Asian buyers. And so that is why you've seen a bit of a price war out there as these two major importing regions are fighting for the LNG that's out there on the water. It's also worth noting, to make this situation even worse, South America, which is a relatively modest importer of LNG, but they're suffering through a pretty historic drought right now. Power demand in South America is usually either hydro or gas. If you don't have hydro, you use more gas. And so actually LNG flows into South America have been quite high as well. It's creating this perfect storm environment, is creating these record high prices. And that's why they've persisted for so long. But let's talk now about what's happening in the US market. So Katrina, if you go to the next slide. So in the US, the story is very, very different. We do remember that going back into September and October and November, there was a pretty healthy run up in natural gas prices, and that caused a lot of concern, understandably so. But if you look at the broader record of US gas prices, you can see the blip that we experienced towards the end of this year actually really isn't that significant. You remember how high prices got during the polar vortex back in 2014. You can see on this chart here the big spike that we saw from Winter Storm Uri. That was the Texas situation back last year. So this run up was definitely concerning, but in the historical context, it's not wholly unprecedented. And there was a lot of drivers of this. And I would point out that more recently, really since, kind of early December of these last couple of months, you've seen the market starting to rebalance here in the US, and prices falling back into the kind of 380 range, which I think a lot of people would say is a little bit healthier and a little bit more sustainable. Now, why are those prices falling? Katrina, if you go to the next slide. This is a really important story. A big reason why prices are falling is because U.S. production is responding very, very aggressively. For a while, when we were seeing these prices run up, there were a lot of questions. Where's the gas? Where are the producers? Why isn't supply ramping up to meet this demand? And in reality, it actually has been. You can see there, going back to the very end of August, a lot of people underappreciate just how impactful Hurricane Ida was on gas production in the US, especially the offshore numbers. So you had a pretty steep fall off at that time. But ever since then, you can see, that was at 89. Ever since then, we've ramped up almost to record levels of gas production. So that, combined with the early warmer start to winter, has really led Henry Hub prices to be suppressed and get down to that level. Katrina, if you go to the next slide. When so much of the conversation was focused on domestic natural gas prices and what's happening, what's driving it, a big and understandable question that a lot of folks had is, well, we're now a large exporter of natural gas, both pipeline gas to Mexico and liquefied natural gas, largely out of the Gulf Coast. Is that what's causing this run up in prices? If prices are getting high in the United States, why are we still exporting natural gas? And that's a fair question, but I think context here is very important. It is true that exports have risen rapidly since 2016. That's when we first started exporting LNG. And actually, as of December, we are now the world's largest LNG exporter. But it's also true that US LNG exports, they're really only about 10% of total gas demand. And perhaps most importantly, they're predicted years in advance. So everybody in the marketplace, all the buyers and sellers, they knew what LNG export demand from the United States would be at about this time. That gives the market time to bake that into their assumptions. And so for that reason, the question of were LNG exports really driving these higher US natural gas prices? I'm not at all convinced. Of course, every aspect of demand plays some role in price formation, but I think really it's the unpredictable events that drive a lot of price escalation. And I think if you look at, say, Winter Storm Uri from last spring in Texas, or Hurricane Ida last fall, I think those are the bigger drivers of what we saw in that run up of natural gas prices through Q3 and Q4 of last year before they started settling down into these more reasonable levels. Katrina, I just have a few more slides, but if you want to go to the next one, it's worth noting, especially sitting there in Pennsylvania, that while prices have really moderated in most parts of the country, there are a few key regions where that's not at all the case. And that's especially true for California and for the Northeast, for New England especially. New England, as you all surely very much know, they have limited infrastructure to bring natural gas into their region, despite demand being fairly significant. And so every winter, they go through this cycle of experiencing very, very high natural gas prices. Again, if Henry Hub, you can see it here, is below, is somewhere around the $4 range, you can see for winter in New England, those prices are up closer to $20 per MMBTU. And indeed, those New England prices, because they still rely on LNG imports to meet peak demand, they actually have a tendency to track global prices. And you remember how high those global prices are. So that's an instance where New England, because of the inability to build natural gas infrastructure to import gas from, say, Pennsylvania, they're forced to bring it in via LNG and pay those super premium prices. California, obviously, you don't have as much weather variability there, but you still have a lack of infrastructure, which means that their prices are routinely, predictably, nearly double what the rest of the country pays. Again, this is largely the result of what, in our opinion, are short-sighted policy decisions that limit the amount of infrastructure that you can buy or that you can build. So one final slide before I pass it over to Dean, just to kind of wrap this up.
I don't have another slide.
Oh, okay. Sorry, Katrina. So I'll leave it there, but just to close, what does this all mean? What is the market trying to tell us right now? And in my mind, the biggest message by far is that the world is sending a very, very clear and loud signal that the world needs more gas and not less. That is what you're seeing these markets tell us. I also think that massive discount between the global prices and the US price, that's a reminder of just how critical it is for the United States to remain a big producer of natural gas, to control our own destiny. You all remember that before the shale revolution, not only was the United States an importer of LNG, we were projected to be the world's largest importer of LNG. Had that happened, we would be just as exposed to these high global prices as what Brussels is, as what Beijing is. But instead, we get them at a severe discount because of the domestic production we have. I think that it's very clear that as we move to reduce emissions, that we remember how important it is that we continue to control our own destiny. So I think that's really the story here as we move through this unprecedented period of time for natural gas markets, is to remind folks just how valuable it is to be such a large producer of natural gas. And of course, nowhere is that more true than in Pennsylvania. So I will stop there and turn it over to Dean unless there are any questions. But Dean is going to provide an overview, more Pennsylvania specific, in terms of what's going on in the industry and what to really look for going forward. So I'll leave it there, and Dean, pass it over to you. Dean?
You're on mute.
Apologies for that. If you would, host, please enable screen sharing so I can bring slides up. Awesome. Okay. So I guess we're going to work from the version that I've sent in advance. Katrina, I was planning with some updates to share a newer version here. But so we only have about half the time remaining that I thought we'd have to go through this. So I'm going to try to hit the highlights and invite you to follow up with analysis and questions, and hopefully leave some time for Q&A today. If you would advance one slide, please. Okay, so as the chief economist, a lot of what I do is to try to make our advocacy and communications relevant in what's happening, and to advise our members, those that don't have advanced planning on the economic strategic planning side, what's happening, what it really means for the business. And as policymakers, I think you said it properly at the opening in suggesting that this is the starting point. Despite concerns about Omicron as a variant of COVID, the continuation of the pandemic, the numbers have been not only high in prices, but high in terms of expectations for economic growth. And I can't underscore enough that as the economy grows, as Dustin was saying, it's natural gas demand that grows almost 1-to-1 in terms of percentage on a global basis, but also oil has been continuing to grow very strongly. So despite a reprieve toward the end of December, here we are back above $80 per barrel for crude oil. You may think as a natural gas producing state, and a major one, that you don't care so much about oil other than the price you pay at the pump. But you do, and you do because the biggest source of natural gas growth last year was actually the Permian Basin in the United States. So, more than 2 billion cubic feet per day of growth coming out of just that one oil-producing basin. So as oil markets go, associated gas along with it comes. This is a source of hesitancy in Pennsylvania, Ohio, West Virginia, as to, if you expect a lot of growth coming from competing sources in the US, do you go all in and drilling in Appalachia? You may not. There are other reasons, and I'm going to try to weave together both oil and gas markets, but price inflation is entrenched. We've been saying this for close to a year, and we see a divergence between, and you can't talk markets down on this. These are problems in a fundamental misunderstanding by this administration of the drivers of price inflation, how enduring it would be. Even the examples that have been offered, from semiconductor chips to automotives, have been off base in terms of expecting production to come back sooner. And if you look at the automotive industry right now, and it's a similar problem actually with the energy transition and energy investment globally, where you've got a relatively fixed pool of capital that's being spread over many more potential sources for investment. This ends up basically with the highest prices being paid ever for automobiles on average. That's not going down. And when I talk to my counterparts across the automotive sector, they don't expect it to go down either. In the semiconductor chip industry, in the automotive industry, both of those are relatively concentrated and have discovered that they have pricing power. You know that food and healthcare and other things have continued to rise. Energy is just the most in your face at this point. And when we're talking price inflation for the broad consumer basket, as of December, Bureau of Labor Statistics, year on year, it was 7.1%. So in the Northeast US, where your average household spends a little over $68,000 a year, that's $400 a month. And when you start breaking households by income brackets, 40% of US households don't have an extra $400 a month. So this is a problem. It means from a policy perspective, you need to make sure that affordability programs are front and center. But in terms of, consumers are just going to get angry and they're going to vote their pocketbook. So your ability to explain this and your vested ability, especially in Southwest Pennsylvania, to understand where the industry is coming from and why investment in drilling and production have been lagging, these are really important. We have, and I don't know if you're aware of it, we publish not only a weekly statistical bulletin, but a monthly statistical report where we put out monthly estimates across all US petroleum markets 2 months ahead of EIA, based on actual survey data, not 2 months in arrears data. As a result of that, we have been ahead of the curve for more than a year in showing that demand would come back and was coming back along with the economy. December 24th, the weekly petroleum status report from EIA that's consistent, 22.2 million barrels per day of US petroleum demand, heading into 2022. So a lot of twos in that. But basically this says that's actually 11% above the same point in 2019 before COVID for that same week. Now, there's a lot of weekly variation there, but EIA's expectations going forward are that the demand side will continue to grow on a global basis. The updated numbers they put out yesterday, by the way, they showed as of December that global oil demand was over 101 million barrels per day. So not only piercing back through this symbolic 100 million barrel per day level globally, but getting to higher than it was in December 2019 pre-COVID. So it's both a US and a global issue that this has continued to grow, and it's because the economy demands it despite the fuel switching that we've seen. And it's especially the growth in materials that we have seen that's been resoundingly strong. Diesel fuel is also strong. Don't get me wrong, the shift towards online retailing. If somebody would please mute. Thank you. So look, investment is key. And let me give you an anecdotal example that's specific to Pennsylvania. One producer that I met with late last year was sharing an example where they had put a drilling rig and crew back together in Pennsylvania. Literally 2 days after they started to get to work, they had to disband the crew because somebody came down with COVID and they didn't have the bench strength of skilled labor to make it happen. Once they solved that issue, they still had to get line pipe and valves through the port of New Orleans, and it was congested. That disrupted their timing. And then after that, they've just had to deal with the issues of financially, how do you ramp up in this environment? And when you look across, especially natural gas exploration and production companies, Bloomberg's tracking of the entire sector is really telling, because historically only about a third of the balance sheet would have been debt. And through the first 2 or 3 quarters last year, it was over half. And if you get to 60%, nobody will lend to you. So it becomes existential to correct it. So you've got a lot of headwinds, both workforce and supply chain oriented, as well as financial oriented. And on top of this, now we have energy policy. And I don't want to harp too much on this, but between resistance to infrastructure from day one, moratorium on new leasing on federal lands, point 2, clean energy power plan that would all but eliminate natural gas in US power. That's the administration's federal position on this, and the plan they're still trying to advance. At the same time, by the way, Europe's reaction to this gas crisis was in the last week or so to propose that both nuclear and natural gas be considered clean fuels. So Europe is actually more progressive, despite being more on the environmental side, they're more progressive than where the current administration is on this. This is really important. It's important for the growth in Pennsylvania, the industry in Pennsylvania, and the signals. It's not just long run. When these policy signals say, look, there's no role for natural gas or for oil in the future, people don't invest at the pace they otherwise would, on top of this workforce and supply chain and financial and other industry issues that have to be overcome here. So I'm going to hit some highlights on slides just to show you and reinforce these points. I wasn't asking you to advance it just yet. The Pennsylvania points, please. Look, you've got record high productivity, the rig productivity, the strength of Pennsylvania production, Appellation production, it is resoundingly strong. EIA's estimates show this. The production has flattened over the last year. About 1 in 5 well completions has been drawn out in the region from drilled but uncompleted wells. That's important for you to know, which means that you've gotten by with less drilling activity, but to grow it in the future, you need more drilling activity. And that means overcoming these issues that we just talked about. And yeah, how you incentivize that and how people understand that it's a supply issue. It's not a blaming exports issue. That's really not what's been going on here. Most of those projects beget their own incremental production. But the cost on the oil side, it means importing more. It means that our inventories are at now below the 5-year range. On the gas side, the inventories have caught up. They were low a couple of months ago. But I'll show you the stocks for propane, for heating oil, and we'll go through. Some of them are tight going into winter, and EIA's projections there, despite the fact that natural gas prices have come back down, could be an issue. If you would please advance one slide. Thanks. Investment, I mentioned that it's low. This is, we call it the API 200. We track the investment by publicly listed companies across the entire industry. This tends to be both US and global investment. The quarterly flow of it's shown on the left. Point 1, 4th lowest on record since 2008. The quarter before that was the lowest ever on record. So these are, in real terms, about half of where they were at the lowest point in the great financial crisis in 2008 and 9. Not enough investment to sustain any kind of growth. That's point 1, and this is a global issue. The projects for investment, large capital projects, and this includes things like the Beaver County ethane cracker and derivatives complex, those under construction, we still have better part of $150 billion worth of US projects currently under construction that we track across the value chain here. These are midstream pipeline processing and downstream manufacturing oriented projects. But this is almost cut in half from where it was just at the end of 2020. So big drop off. Think of it as a funnel of stuff going in, stuff coming out. You're not getting, it's very difficult to advance these large multi-billion-dollar projects in this environment. Advance, please. I mentioned that the drilling's not enough to keep up. This is the gap in drilling versus, if you want one summary statistic that you can take home and use as a pulse of what's happening in global oil markets, it's the futures prices for crude oil internationally. So these are Brent crude oil futures for delivery 1 year ahead. It's usually a leading indicator of drilling activity. It's tracked really strongly across history, you see here. But look at the gap since 2020. Wow, it's just not enough. It's not, and it's not just US or publicly listed companies that you know by brand name. It's OPEC, it's Russia. Nobody has invested over the last 2 years, and this is what's showing up in gas markets internationally right now, as well as oil markets. If you'd advance, please. This is Pennsylvania specific, comparing crude oil prices in blue with US and average gasoline prices, retail prices from AAA in white here, and then the Pennsylvania ones in red. And then the area in red at the bottom is just your difference in your state versus the nationwide average. And notice point 1 is that where crude oil goes, gasoline and diesel fuel, that's where those prices go. I mean, it's the number one input. It's 50 to 60% of the input cost per EIA. That's the pulse and what you have to watch, and consumers need to understand that that's where it's coming from. There's nothing other than that. Now, Pennsylvania moving since really 2013 and 14, since 2014 to above the nationwide average, that is a direct correspondence with the increased gasoline price taxes that Pennsylvania has had. So you've had 3, 10 cents at a time kind of increases between, I guess, 2014, 15, 17. It's actually, the difference to the nationwide average has actually come down a little bit over the last year. I think that's good news. It's narrower, but crude oil prices are still a concern here. If you'd advance, please. Appellation natural gas production. So this is a model that we maintain that's calibrated to EI's drilling productivity report. You see the mix, it's almost entirely dry natural gas, so without liquids content in it across Appalachia. So this is West Virginia, Pennsylvania, Ohio, that's included in there, but the largest segment is Pennsylvania. The match of the production with the pipeline by pipeline capacity balance, it's been tight. You have enough, but this is another long-term point that especially in Pennsylvania, you need to be aware of, that if you want to realize the long-term vision for Marcellus, Utica, or greater Appellation natural gas growth, when McKinsey or others come out with long-run outlooks, they show a before and after of a US map with larger arrows for natural gas flows coming out of Appalachia. That doesn't magically happen without infrastructure. So when you have infrastructure that's been canceled over the last year, or you have infrastructure that makes its way to parts of Maryland or New Jersey and stops there and doesn't actually get to a market, that's not entirely helpful. You need market access, which means working across the region to make this happen and working with industry within the state to make sure that the demand growth and the supply growth are matched pretty well. If you'd advance, please. I mentioned the productivity is record high. Appellation productivity is shown on the right. The left-hand side is showing a break-even estimate from BTU Analytics. Break-even meaning what price, market price for natural gas do you at least need to break even in drilling a new well. The point is that even at $4 gas, not the close to $6 that we saw a few months ago, the break-evens are so low, especially in Pennsylvania, that you should be able to drill and make money all day. Now, these are distributions. This is an average that's being shown here, and there is a distribution within any production area. But again, lots of headroom here. So the issues of why you don't see the drilling activity that we'll look at in a second go back to those fundamental supply chain, workforce, financial, and policy issues. Advance, please. This is Pennsylvania's specific drilling activity versus the natural gas prices. So the analog to the drilling chart that I showed you for oil on a global basis, this is your Pennsylvania specific one, where natural gas futures are really your pulse of where your drilling activity has historically gone. But look what's happened. It's flatlined. You have drawn down more from drilled but uncompleted wells across Appalachia. The prices, they've gone up, they've come down a little, but there's still plenty of headroom there. But it's this lack of drilling activity on the natural gas side, especially dedicated gas drilling, that could be problematic in the next year or so. Advance, please. The stocks of crude oil, I mentioned below the 5-year range. You see it here with the red on the left. This is pad 1. So this is up and down the east coast of the US specifically. Heating oil stocks, that's a form of distillate. You have some heating oil used in Pennsylvania and across the region. And in the Northeast, generally more heating oil than other parts of the country. Those stocks have been low, and the prices obviously go along with those of crude oil, just like gasoline, just like diesel, and hence those prices are elevated, and that feeds into EIA's outlook. Propane is used especially, when I lived in Lancaster, some friends of family, they raised chickens, and they would use propane through the winter to keep them alive. This goes with a lot of different kinds of livestock farming or agribusiness. Propane, the stocks are actually pretty healthy. That's a good point, but the prices also are elevated because, again, they tend to go along with liquids prices in general. I think that should end, but if you'd advance, please. There's a chief economist section at api.org. Please feel free to reach out to me on LinkedIn, through the website. The reports that I've mentioned, including our complete quarterly presentation, our monthly statistical report that I referred to, please feel free if you have custom needs to reach out to us and ask. And we have a lot of state specifics that we can dig into in addition to the things that I've reviewed with you here today. So with that, let me cede the rest of the time and see if we have questions.
Thank you to both of our presenters, and we're trying to speed it up just a little bit here. So please, anyone with questions, please go ahead and ask. And I'll throw one out there. You were speaking, Dean, about national security and Europe and their need for gas and things like that. And I just read, I think it was this morning, that there are European nations out there who are really relying on Russia to provide their natural gas. And it's being used as a political club to control these countries. And if the United States would only produce the natural gas that's needed to send to these countries, they could be independent, and we would then have them, be more friendly to the United States and have leverage on Russia right now. And it's mind-boggling to see that we have tanker trucks coming up to our eastern seaboard to offload liquid natural gas. And we have it in, as you just explained very well, abundance right here in Pennsylvania. And to have an administration that is putting a stranglehold on that, I think it's not just a local issue, a state issue, a national issue. It is an international issue. So I wanted to thank you for your very clear message in your slides, and I'll turn it over to anyone else who might have a question.
Camera, right on point there. Right on point there.
Absolutely.
You said exactly what I wanted to say, except I also want to know about pipelines. Are we missing the mark on pipelines too? Is that part of a problem? But then we can go on.
Yeah.
I think you addressed that earlier, but I think that needs to be part of the conversation as well.
Absolutely. Pipelines are important. We've had a couple of major projects that have been canceled out of the region, including the Atlantic Coast Pipeline that would have taken some Appellation gas and moved it to more Gulf Coast kinds of markets. Access to international markets for Appellation gas is a critical issue if you're not developing the demand within the state and the region. So how you make that happen, given the resistance to infrastructure in neighboring states, is an issue. How you find ways to make sure that they get to a terminus that isn't just the adjacent state, that if it gets there, that it actually gets access to these markets. You have, with the Philadelphia Energy Solutions refinery, that former location, maybe the ability to do something creative with that. I don't know if it'll turn into a renewable diesel refinery or an LNG export facility, but with some state support, something, some energy for that region that would help Philadelphia as well would be good.
Great. Any other questions? I'm looking in the chat. I didn't see anyone put any questions in there, but in the interest of time also, I really do want to give everybody here on the call. I know we have a lot of people, and I'm thrilled that there's this much interest in the caucus and this message and this issue. But if there are questions that people think of later on, please send them over to my office, to Senator Boscola's office, to the representatives' offices, and we will get them to the right person and make sure that the answers are communicated to you in a timely fashion. Are there any other questions as we move along here? Okay, seeing none, hearing none. I want to thank our guests very, very much. This is a lot of great information, and this is something that we all need to be thinking about as we move forward in trying to not only uplift the economy of Pennsylvania, but provide for jobs, cheaper energy, greater opportunity for capital investment with those that can use natural gas in Pennsylvania for factories and manufacturing. So thank you so much for all of this. Stephanie, thank you very, very, very much for facilitating this great kickoff to our caucus. I appreciate your time and the expertise of our panelists. And Dustin, thank you very, very much for everything. I appreciate it so much, and we will definitely be in touch.
Thank you.
I think right now we're going to move forward with our next panel, and I believe that our good friend, Mr. Dave Callahan, new president of Marcellus Shale Coalition, is going to launch into the next panel.
Thank you, Senator. And thanks to the chairs, Senator Bartolotta, Senator Boscola, and our House chairs, Nelson and Neilson. Thanks to the members of the Gas Caucus, Gas and Oil Caucus for attending, and of course, for members of the Marcellus Shale Coalition for joining on as well. Katrina, I have a few slides. If you would just jump to slide number 2, we could dispense with slide number 1.
Sorry, give me 1 second. We'll pull up your presentation.
That's okay. And honestly, I'll start talking about it before it even comes up. It's just an introductory slide to the MSC. The MSC, we have over 110 members of the organization. We have members from the upstream, midstream, downstream segments of the industry, meaning those who produce natural gas, those who transport natural gas, process natural gas, and fractionate natural gas liquids, and those downstream of those entities as well, those that may produce electric power, and those who distribute natural gas as well. And of course, any number of businesses that provide goods and services to the industry as well. All these entities, all these companies involved in the MSC, and as well as with my colleagues at API and their membership as well. day by day, their employees are going to work and doing the hard work to make this country energy secure, something that I know Senator Bartolotta, you touched upon, something that's already been touched upon, but making our country energy secure for the first time really since the very, very, very early days of the Eisenhower administration. Katrina, if you could go to number 3, we could just kick off right there as well. Just want to talk a little bit about the Pennsylvania price differential. Dean and Dustin did a great job of discussing global prices, a little bit of what's going on in Pennsylvania, or pardon me, a little bit of what's going on in the United States itself. And I think it was Dustin who had a slide where he looked at Algonquin prices and different prices in the United States. When you see prices quoted generally, if you pick up the Wall Street Journal, if you're watching CNBC or anywhere else, generally speaking, they're going to be talking about the Henry Hub price. The Henry Hub is located in Louisiana. It's a hub where roughly 13 pipelines are in the vicinity. That's the price that you see there. Prices in Pennsylvania are suppressed compared to that. As you see on this chart, we look at January prices going back to 2012. And while you see some general correlation in prices, you see a difference, a significant difference at times. Right now, looking at January 2022 prices, the difference is roughly 90 cents. And I think it was Dean who pointed out that one of the primary reasons for that is lack of sufficient pipeline takeaway capacity out of Pennsylvania into those markets where the natural gas is needed. Recall, I started off this slide by saying that down at the Henry Hub in Louisiana, we got 13 pipelines. Here in this region, we'd be blessed to have a few more just so we can reach some markets. Katrina, if you would, please. A little more on natural gas pricing in Pennsylvania versus Nymax. Here on this slide, we look at the price differential going out throughout this year, 2021. Again, my colleagues, my esteemed colleagues at API pointed out some of the instances and some of the pressures that were bearing down on not just US prices, but global prices. And you see there was a ramp up in prices as we recovered from the economic shutdown. But then again, those prices sent signals to the market to produce, as the United States producers did. And we saw some moderation as going into November and December of 2021. Katrina, please. Again, a slide that I think was shown on spot prices. We use a little slightly different. These are some actual prices and some futures prices as well. But you see there's the big difference. For context though, while we have seen some increase in prices here nationally, and of course globally, you see the global price noted on there as well. The prices have moderated significantly from years past. And what you see is before the shale revolution and after. Again, going back to one of my previous points about independence and dependency, you could look at the line to the left, the before shale development. That's what energy dependence looks like. You look at the lines to the right after shale development, that is a clear sign of energy security. Katrina, please. That has an impact here in Pennsylvania, a significant impact, and has had a significant impact over the years on natural gas consumer prices. Here you see a plot comparing 2008 to 2020 prices. That's the purchase gas cost price that our natural gas distribution companies charge and receive here in Pennsylvania. You see differences ranging from 66% up to 85%. Katrina, if you would please advance the slide. What that amounts to is roughly 74% drop from 2008. Now, I know you're looking at this slide, if you're paying attention now, if you're looking at this slide, you see that those numbers end in 2020. That didn't take into consideration the recent run-up, and there's a reason for that. We utilize a report from the Pennsylvania Public Utility Commission that looks at annual prices from the natural gas distribution companies. That report is issued, I believe, in April of every year. And so we'll have an update to this slide when that report comes out from the PUC. But bear in mind that there's nothing there in that report or what we foresee coming out in that report on 2021 prices that would do anything to increase those prices anywhere near where they were in 2008. There's a significant drop, and the shale revolution is the prime reason behind that. Katrina, please. If you take the average customer usage across the board, and you can see some of that, those percentage drops result in real dollar savings. Dollar savings of well over $1,000, most of them well over $1,500 per year for consumers. Katrina, please, I'm trying to keep us moving here. For consumers, though, there are opportunities to try to save. Pennsylvania, the Public Utility Commission has a Pennsylvania gas switch website that's comparable to the Pennsylvania Power Switch website, where consumers can search for not just competitive electric providers. The PA Gas Switch allows folks to look for competitive providers for natural gas. People have been allowed to shop since 1999, and I think that given the current price environment, there are more opportunities to shop as well. You see all kinds of offers there, fixed and variable. You could lock in for a short amount of time, lock in for a long amount of time. And believe it or not, I checked in when we were planning this presentation. I looked at my price to compare for my natural gas distribution company, as well as some of the offers. And believe it or not, there were two offers from the same company for kind of a pay one price, use as much as you want, almost like unlimited data from a mobile phone provider. So they should probably be marketing this as the teenager plan, but anyway, regardless, there are plenty of opportunities out there. With that, I thought I ran through it rather quickly. I think that's near the end. Katrina, I think we have one more slide. We send out a lot of information. We compile a lot of information, I should say. We analyze what's going on in the news. We look at prices. We look at what's influencing factors in the industry and around the industry. And we amalgamate that stuff and we send it out on a regular basis through blog posts, through news releases and others. If you want to get this stuff delivered to your inbox directly, you can click on the link included in this slide deck, and we'll send you that stuff automatically. It won't clutter your inbox. It's just a report or so a week. And trust me, you'll find it informative. And with that, Katrina, I think I'm finally at the last slide and we're almost on schedule. And if folks have questions, oh yeah, 2 whole minutes to spare. I'm happy to entertain any of your questions.
We have more time. If we need it, we'll be here until people need to go off to their next appointments. But Dave, thank you so much for that. And I highly, highly, highly recommend that everyone get on that newsletter, because if you're a member of the Gas and Oil Caucus, even if you're a representative in any shape or fashion on any committee, energy prices plays a huge role in everyone's life across all of Pennsylvania. So get on that newsletter so that you can stay up to date as well. And right now, if there are questions, I'm looking in the chat. I don't see anybody who requested it. I don't see hands raised. You know, we have 63 participants still. So there's got to be some questions or maybe comments or anything. And I will open it up. I see Pam Snyder down there. And Pam, thanks for being here. And I know Pam and I were on a FaceTime call on October the 9th. I know the date very well. It was the day before my daughter's wedding and I was in New Orleans. And Pam and I got a help me call from Toby Rice, and he explained how the incredible increase in the pricing and everything was affecting us, and not able to get this product to market, and how it's influencing not just locally but globally. So David, I loved one of the statements you made, and I wasn't writing quickly enough, but I loved what you said about the security of not just Pennsylvania, but national security. Tell me again, maybe you have it handy, since the days of in the 30s.
Sure, Senator. My colleagues from API might have a specific date, but I believe it was the early 1950s was the last time we were energy secure in this country. We've enjoyed energy security for the last couple of years, thanks to the shale revolution, thanks to policymakers like yourselves that have allowed the shale revolution to take place. We need additional help to make sure that it can continue, to make sure that it can grow. One of the things that we need, one of the things that would be helpful, again, to Senator Boscola's point about infrastructure and pipelines, We need infrastructure to get product where it's needed. We need infrastructure to get product to the markets. We also need coherent, consistent policies so that we can increase usage here in Pennsylvania. I read with great trepidation a couple of major announcements from other states landing big steel company investments. I'd love to see that stuff come here where the energy is affordable, where the labor force is highly skilled, highly trained and motivated. We've got everything they need. It'd be great to see some of that come back to Pennsylvania.
Absolutely. Yes. I think we need a huge shift in our mindset at the top of the ladder in order for that to happen. I know that we do have some questions from different caucus members, and we will be submitting them, and we'll get them into the right hands so that the answers can be given. So I think Lisa Boscola, Senator Boscola, did you have?
Just really quickly, you know, when I go around my area, right, the one thing when people hear about, well, prices are rising, inflation's up, like for you know, 40%, whatever it is, they ask me, they go, why, Lisa, if we have such a robust natural gas industry here in Pennsylvania, why are we going to experience higher prices? And I'm just trying to figure out how to word that and say that in terms that they can understand, my constituents. Because the people on this panel, we all know what we're talking about, right? We've been in this industry, we're privy to the information, but the average person out there is not, and they have no clue. They just feel this is malarkey and that, you know, these big companies are controlling the market and they're just going to get what they're going to get. They don't need the money. They don't need, you know, an increase of 40% in home heating bills or anything like that. They just think it's a power grab by these companies. And I want to know how I combat that in a concise way. And you don't have to tell me now, but if you know, in a follow-up conversation, think about it. And Cameron and I can even work on that. Because I'd like to come up with, I might even do a postcard or something out to residents explaining what's going on in our economy, inflation, and how this impacts their lives, and maybe incorporate this in. But I got to come up with something concise, and I haven't figured out how to do that yet, if you know what I'm saying.
Oh, certainly understand, Senator. And for Dean and Dustin, I mean, I think we all had a slide on there showing historic prices. Again, pre-shale revolution, post-shale revolution.
Right.
And what you see there is that we're nowhere near the volatility that we experienced pre-shale revolution. We're nowhere near the high prices that we experienced and when we were truly energy dependent. What we've seen is an increase, and that's just the market reacting to prices, the market working the way markets do. But what we've seen is an increase from absolute historic lows, generational lows in prices. So, for example, now I know folks don't like to talk about raising taxes, but if you raise taxes, you know, from a very low percent to, you know, a little bit more, the percentage increase might be huge, but the actual amount might not be that much at all. It's that percentage increase that might be throwing people off when they're not looking at the actual numbers.
That could be true too. Although any increase in prices is going to create constituency to be a little outraged, and why.
Well,
but my biggest challenge is because we're supposed to be one of the biggest producers of natural gas. Why are we experiencing this? That's the question I have to answer.
Sorry, what I tell people is, yeah, you know, we are one of the largest. We should be the greatest producer, but not just producing it, because you can produce, you know, widgets all you want, but if you don't, if the
get them to market,
if the doors to the store where you sell it are locked to you,
right? Okay.
Produce. Why are you going to keep producing it? You're not selling it. We need pipelines. Yeah,
right.
Pipelines.
Okay.
We need to transport that resource to market. And that is, I think that's where we get lost. And what I keep telling people too is that we need a great message about pipelines. They're the safest, most efficient way to transport any of these products. And to get 200,000 plus trucks off of our roads and bridges and infrastructure, everybody knows how bad the infrastructure problem is. Stop beating it up with hundreds of thousands of trucks. Best way to do that, put it in a pipeline. Safest way to do it, put it in a pipeline.
Yeah.
And again, to Senator Boscola's Oh, pardon me, Senator.
Yeah, the PR was bad on that one. Pipelines, we've got to change that narrative.
Go ahead, Dave.
Well, I was just going to say, and to that point, recall one of the slides that I had early on showing that price differential. Prices in PA are incredibly low compared to the national benchmark. That's a point for your folks to know as well. They are lower here because there's increased production. Unfortunately, they're lower here as a result of constrained capacity as well.
Got it. Well, thank you. I don't want to take up the time. I just I'm kind of a little frustrated myself, if you can tell, on how to.
All right, Representative Nelson, Katrina texted me and said that you had raised your hand. For some reason, I'm not seeing that on my screen. So go ahead with your question, your comment, sir.
Sure, that's great.
That's because he's not good at hitting the computer buttons. I apologize for him, Senator. You know how he gets, though.
Katrina, where's that mute button I told you about?
Yeah.
Sorry. Go ahead.
The only member with 2 pictures of himself on a screen. It's definitely got to give him credit. But I do agree with you on the importance of pipelines and being able to get Pennsylvania natural gas access to market and trying to, decrease the differential between Pennsylvania gas and natural gas. Dave, what would you say is, this is a great kickoff meeting for 2022 and Pennsylvania energy opportunity. What would you say are your next 2 and 3? So we understand the importance of pipeline to be able to get, and increase the supply to consumers to be able to bring those costs down. What would be, your top next 2 for Pennsylvania as we start to look at this next legislative session?
Well, this is regardless of whether it's this session, last session, we need predictability for permits. We need predictable turnaround times for permits. We're in competition. This basin, while it's been highly successful, it's where Pennsylvania is the number 2 producing state, Appalachia is the number 1 producing basin. We're in competition with other basins. The Haynesville down in Louisiana, Permian and elsewhere. Capital flows where the policy environment, where all the factors all come into consideration, where it makes sense for it to go, where the dollars flow like water. One of the things we need is predictability on permits. That's something that we can't predict. It's something that shouldn't take as long as it does. It's something where freelancing by permit reviewers can boggle the mind, can slow up projects all the time. It's an number 1 issue for us as well, along with increasing opportunities for downstream utilization. We saw from a short time ago, before the holidays, the announcement by Nacero, where they're going to be investing $6 billion to utilize Pennsylvania natural gas, to utilize very clean motor vehicle fuels. We need more of that. We need more opportunities like that to show folks the downstream opportunities of this great resource. Once the Shell petrochemical facility comes online at some point this year, hopefully we'll be seeing more opportunities there as well for additional downstream manufacturing opportunities.
Dave, you used my favorite word. I've been using that for years, predictability. It's a dirty word in Pennsylvania for some reason, but we need it in all aspects of government, in planning, in permitting, in regulation, in taxation, in everything. You're absolutely right. So, and my other favorite P word is pinata. And this industry's been hit like a pinata every single year. You want more and more and more out of it, but you just keep whacking it. So
I do agree with you, Dave, too, on the consequence of losing that U.S. Steel opportunity, all that equipment that's been sitting on the banks of Pittsburgh, jumping on barges and heading to West Virginia and down into Alabama for 2 alternate investments. Hopefully together, that's one of the goals of this bipartisan caucus, is to be able to work together to drive those hundreds of thousands of union labor to build the plants, to use the gas, to pay the people. And, it all connects together, and natural gas is a key element of that. So thank you, both API and MSC, for your, testimony or information today.
thank you, guys. Katrina, do we have any more questions out there that I can't see? I can't see hands raised.
Nope.
We're good? Okay. Dave Callahan and Stephanie Wisman, thank you so much for being here, for bringing this amazing information to us. It's a great way to kick off the new year. And we've got our work ahead of us, and we will use you as resources throughout this year whenever we have questions about this. And again, thank you to everybody who is here on the call. We're down to 57 members now, but thank you all. Thank you, Senator Boscola. Thank you, Representative Nelson and Neilson. Thank you for being here and keeping your caucus members included and up to date on everything. And we look forward to the next caucus. And I think that's it. And I think we had a great use of our time this afternoon.